My first run-in with an economic cycle was actually 18 years old. I was working right here, South Coast Plaza over at Nordstrom. This was 2004, 5, 6, going into 7. People just blowing money on things. Money was flowing, retail was crushing it, and luxury goods were flying off the shelves. That was the increase of the cycle. But then we turned in 2007, everything started to decline. Bad financial moves and like loose operating started to catch up. The retail world went from being slam packed to where hours were being cut and there was really nobody looking to buy anything, right? Just a few customers. I didn't know at the time why it was happening. I just knew it was happening. Now, after 15 plus years in financial services, I know why it happened. And what I want to do is show you why it happened and help you better understand where are we right now in the cycle. And if you know why things are happening, you can put yourself in a better position to benefit from them or to be safe harbored from the negative effects rather than looking back and just saying, oh man, I remember when I got caught up in that. So economic cycles, they're inevitable. They're gonna happen, they're gonna move through the phases, and there's nothing you can really do about it other than understand it and position yourself well throughout them. First phase is expansion. This is when things are going well. They're expanding, companies are growing, they're adding jobs, people are spending money. You just feel like everything's going well, right? Like Roaring 20s style, think of that. That only goes on for so long, right? So that moves us into peak. Peak is when things have kind of gotten as good as they're gonna get for this run. Now things are gonna start to shift. And so there's this point where you see things kind of feel stale and then they start coming down and reality is setting in that how long could it be as good as it has been? From peak, you move into contraction. Think about what happens during contractions, right? Things are getting smaller. When companies are contracting, they're laying off, they're spending less, they're cutting budgets. These are the things that start to happen during that period of time. Money's not as loose as it was.
We are out to save money.
Contraction will happen for a period of time until eventually it kind of resets. We hit the trough. The trough is like the bottom, right? A trough is like where animals feed from, right? But it's kind of that leftover, it's all that slop. It's not gonna get much worse than that for that cycle. And then it begins to start over. So out of trough, we start to expand and grow and rinse and repeat. And this happens over and over again. You might recall a famous cycle that happened in 2008. It's been nicknamed the Great Recession because of how much impact it had. But it was hitting people from your luxury brands like Gucci, Rolex, Wall Street, all the way down to your mom and pop shops. We all felt it. And whether you were coming up in your youth or you were gearing up to retirement, I'm willing to bet there are still scars that you feel from what happened back then. So now you're in that frame of mind, you're thinking about those scars, like what happened to you in 2008. Let's talk now about why it happened. So it got labeled as the Great Recession. This was the biggest decline in our economy since the Great Depression in 1929. Here's a little bit of like a history lesson of what took place. The peak for that period was October 2007. Stock market was at its peak. Interest rates were at their peak, and then the Fed began to lower rates. But why did we get to that point of having high interest rates?
I don't know, you tell me.
Just a few years earlier, like 2004, 5, and 6, money was cheap. Back in 04, it was like 1% rate. Well, cheap money led to risky lending. Easy come, easy go. Banks let people have money easier. Banks were letting people get house loans off of stated income. That means that I could be flipping burgers, but when I go sit down with my mortgage broker, I tell them that I make $150,000 a year and they take my word for it and put it down on the application and then they give me money because the money was cheap to them, so they lent it out. That created a housing bubble.
The housing market is propped up on these bad loans. It's a time bomb.
And so companies like Lehman Brothers being the greatest example, right? The 4th largest investment bank in the nation goes bankrupt one day. Boom, September 2008, one day, wiped out, stock worth 0, bondholders destroyed.
Well, that's not good.
This was the largest bankruptcy in American history. So that now creates a ripple effect. People are freaked out. And what do they begin to do? They begin to contract. So this was the tail end of 2007. All of 2008 was contraction. People holding their money tight, not spending, everyone saving. People not knowing how deep, how fast, how long will the contraction last. They're not willing to take any risks, and everything begins to tighten up. We go into contraction. We hit the trough in 2009. How do we get to a trough? Basically, when this is happening and it's like a runaway freight train, the Federal Reserve gets involved and says, okay, we've got to control stuff. How do we loosen things up again? So they start lowering interest rates. They start making money more accessible so corporations can begin to expand, put projects together, hire, add people, get the economy and things rolling again. That was happening during this period of time, but it took from October of 2007 to March of 2009 to go through that contraction period. As I said, these cycles happen over and over again. So you can look back to the dot-com bubble or all the way back in history to 1929, the start of the Great Depression. But what does that mean for us now? Strategic financial planning can help keep you above all of the chaos that's going on. With interest rates changing and a looming environment, now is the time to make sure you make some decisions for the next turn of the cycle. So it's September 2024. Where are we in the cycle? Well, let me tell you, I believe we are right about there, just cresting past the peak and beginning to go into contraction. But before I tell you why I think that, let me tell you what has led us here so far. A couple of things. Printing of money. We all remember in 2020, there was a global pandemic, lots of stimulus that was being made. So money was being handed out for all kinds of different reasons. But when you print money and add to the monetary supply, you create inflation. It is a formula for that. So we saw inflation start to rally hard. Things got a lot more expensive. We all felt it in our pocketbook. And so to try to get control around that, the Federal Reserve started to rise interest rates to slow things down because there was cheap borrowing available, right? In 2020, they lowered interest rates to the ground. So you could refinance your house for practically nothing, right? Or finance a new one, buy a car for super cheap. Businesses could borrow money for projects. And when you get access to money like that, as I was saying before, right? Easy come, easy go. They're more loose with their spending. And then also we had some massive supply chain issues during COVID. That meant that there wasn't more product available, but there was more money available to people. So they were willing to just pay more if companies had to raise their prices because they had limited supply. So because of that, inflation happened, and it took us to way above what the Fed wants. 2.5% inflation year over year is the target. We got up to 9+ on paper, and there are many reasons to think that if you really dissected it was worse than that. They started raising rates, and they raised them all the way until they just peaked. This month, the Fed announced that they lowered rates, and they lowered them by 0.5%, which might not sound like a lot, but they were at 5.25, and they dropped them to 4.75.
I like the sound of that.
You know when the last time is that they dropped them that same exact percentage? 2007. What's going on here? I don't know how long this is going to last. The Fed is looking for us to experience what they would call a soft landing, right? But if they're able to accomplish that, they'd be the first Federal Reserve to ever do it. Should we take their word and hope with them it's going to be a soft landing, or begin preparing for what could actually be another serious contraction? You're going to have to decide how you feel about things, but I'll tell you, during these times of contraction, some of the things you want to think about are like, what does job security look like? What industry are you in? If we do contract, how's your company going to contract, right? Are you hitting your targets, and do you feel like you've got a strong hold on that job? And then also investments. What's going to happen? Should you be pushing things on the sideline? Should you be partaking, seeking investments that make money when it goes down? These are all questions I can't answer for you right here. I just want to get you thinking, because we don't know how that is exactly going to pan out. All I know is that we are right there, and the beginning signs have taken place. We're gonna keep diving into this stuff. If you're sitting back and you're wondering like, oh my gosh, what do I do next? Or you're watering at the mouth because you know these can create significant opportunities, subscribe to the channel, share this with someone who might need to hear it. Stick around, because we're gonna keep diving deeper into these things and share with you more and more of how to be in the know of what's happening in the economy.